Machine learning is revolutionizing industries, but its impact is particularly transformative in finance. Imagine a world where data drives decisions, replacing traditional methods with predictive models that can process enormous datasets with precision and speed. This is the power of machine learning. At its core, machine learning is a form of artificial intelligence that allows computers to learn from data and make decisions without being explicitly programmed. These systems continuously improve, refining their algorithms to deliver better results over time, making them indispensable in financial markets. A key application of machine learning in finance is predictive analytics. Banks and investment firms use these algorithms to forecast market trends, assess loan risks, and detect fraud. Machine learning also transforms risk management. Financial institutions model different risk scenarios, allowing them to predict potential losses and optimize their portfolios. Moreover, machine learning enhances customer experience by personalizing financial services. Tailored credit offers, investment advice, and customized banking experiences are all powered by data. As machine learning continues to evolve, its role in finance will grow even further. From improving decision-making to offering personalized services, the future of finance lies in algorithms. Historical evolution of machine learning in financial markets. The evolution of machine learning in financial markets has been nothing short of revolutionary. Let's take a journey through its transformation. The story begins in the mid-20th century, when early computers and models were used to analyze vast amounts of financial data. These models were basic by today's standards, but they laid the groundwork for what was to come. In the 1980s, more powerful computers and larger datasets enabled the development of more complex models. Financial experts began using historical data to predict future market behavior, reshaping financial strategies. The 2000s brought the internet explosion, giving rise to vast amounts of data that could be processed in real time. Machine learning algorithms became more refined, enabling faster and more accurate trading decisions. Today, machine learning dominates financial markets. Technologies like deep learning process massive datasets instantly, allowing for critical decisions to be made in milliseconds. Machine learning is now democratized, accessible to both hedge funds and fintech startups alike. Looking ahead, machine learning's potential in finance is limitless. However, with great power comes the need for transparency, ethics, and smart regulation. Machine learning isn't just a tool, it's reshaping the global financial landscape. Essential machine learning concepts in finance. Unlocking the power of machine learning in finance requires understanding its key concepts. Let's explore the fundamentals driving transformation in financial analysis, risk management, and forecasting. Supervised learning, where algorithms are trained on labeled data with correct outcomes. In finance, this is used to predict stock prices, assess loan applicants, and forecast economic trends by analyzing past data. Imagine predicting future stock movements by studying years of market history. This is supervised learning in action. Unsupervised learning, which works with unlabeled data to reveal hidden patterns. In finance, this can identify clusters in customer spending habits, enabling financial institutions to tailor products and services more efficiently. Reinforcement learning is another exciting method. Algorithms interact with their environment and learn from both successes and failures, refining their strategies over time. This technique is particularly useful in algorithmic trading, where systems learn to maximize gains. Decision trees are visual tools that break down choices and outcomes. In finance, they help determine optimal investment strategies and risk management decisions. Neural networks, inspired by the human brain, are crucial for identifying complex relationships in financial data. A subset, deep learning, takes this further by processing unstructured data like financial reports and market news. Finally, natural language processing, NLP, is used to analyze sentiment from news or social media, providing valuable insights into market trends. These concepts are no longer reserved for large financial institutions. Smaller firms and individual investors can now leverage these tools. Understanding these concepts is essential for tapping into the full potential of machine learning in finance. Traditional financial analysis versus machine learning approaches. The rise of machine learning has transformed financial analysis, shifting from traditional methods to dynamic, data-driven approaches. For decades, financial analysis relied on statistical methods and manual intervention to predict market trends, banking outcomes, and investments. While effective, these methods were limited by their linear nature and reliance on structured data like financial ratios or market indices. Machine learning, on the other hand, offers a more flexible solution. It can process vast amounts of structured and unstructured data, such as text, images, and real-time market updates. This allows it to uncover patterns that traditional models might overlook. Machine learning excels in analyzing complex, nonlinear relationships in financial data and adapts over time as it processes more information. This ability gives it an edge in fast-changing environments where consumer sentiment or political shifts can suddenly impact markets. Another advantage of machine learning is its scalability. It can be applied to various data sets without needing extensive reconfiguration, making it ideal for handling vast data sets in financial services, whether for fraud detection in real-time transactions or automated trading systems. The impact of machine learning on financial strategies. Integrating machine learning into financial strategies has changed how institutions and individuals manage money, make investment decisions, and assess risk. It's not just an improvement, it's a revolution. Machine learning excels at processing large volumes of data and learning from it, making it ideal for the fast-paced nature of financial markets. Traditional methods struggle to handle the sheer volume of economic data, while machine learning thrives on it, offering deeper insights and more informed decision-making. One of its most impactful applications is in refining investment strategies. Machine learning models analyze historical data and real-time market changes to uncover opportunities that human analysts might miss. Machine learning is also transforming risk management. It predicts potential risks by analyzing complex patterns that traditional models often overlook. In a world where market conditions are impacted by various factors, geopolitical tensions, global health crises, etc., this predictive ability is invaluable. Moreover, machine learning allows financial institutions to personalize their services. It offers tailored banking advice, credit options, and investment suggestions based on individual spending habits and financial goals. Automation is another key benefit, as machine learning streamlines routine tasks like loan processing and customer inquiries, reducing costs and improving accuracy. Despite these advances, there are challenges, including concerns about data privacy, security, and over-reliance on automated systems. However, the transformative potential of machine learning in finance is undeniable. Ethical considerations and challenges in machine learning. As machine learning reshapes finance, it also raises ethical challenges. Algorithms making decisions with limited transparency raise concerns about fairness, accountability, and trust. One major issue is bias. Machine learning models are only as objective as the data they are trained on. If historical data contains biases, algorithms may perpetuate these biases. Another challenge is the opacity of machine learning algorithms. Often called black boxes, these systems make decisions that are difficult to understand or explain, creating problems in industries like finance, where transparency is critical. Finally, data privacy is a significant concern. Financial institutions handle vast amounts of personal data to train machine learning models. Protecting this data and ensuring compliance with regulations is crucial to maintaining consumer trust. To address these challenges, financial institutions must work with regulators to establish ethical guidelines, promote transparency, and ensure that machine learning is used responsibly. By doing so, machine learning can benefit everyone in the financial sector.